Amid all of the tariff talk, our guest says investors are ignoring a positive earnings growth story. Let's get more from Michael Landsberg, Chief Investment Officer at Landsberg, Bennett Private Wealth. Thanks very much indeed for joining us.
My pleasure.
So corporate profitability, you reckon, still okay, even though quite a few companies have withdrawn their forecasts?
Yeah, Andrew, I think they've withdrawn forecasts because it's pretty easy to do given kind of the lack of clarity in the U.S. around tariffs. But if we look, last 12 months, S&P earnings are up over 11%, and NASDAQ earnings are up over 22%. So it's a very strong backdrop for earnings. But I think what's happened is this kind of lack of clarity, this fogginess with tariffs have given people a reason to say, hey, let's put some cash on the side, and given companies the opportunity to say, let's pull guidance because no one's going to penalize us for doing that because of what's going on.
I suppose you do get penalized down the road if you didn't warn investors.
I think sometimes if you pull guidance, I think a lot of times analysts and portfolio managers are concerned about what you're doing and do you not know what's going to go on. But I think what's happening now is it's becoming kind of par for the course. Mm-hmm. So if you have an opportunity to pull the guidance or at least push it out a couple of quarters and not give any, it gives your stock a chance to breathe and you a chance to execute.
Are you overweight the U.S. right now, or have you lightened up on your positions, given that other investors seem to be pulling back to some extent from U.S. assets?
Yeah, we lightened up. We rebalanced. We lightened up in January. What's happened in the U.S. is obviously the tech-centric NASDAQ has done well for the last couple of years. But what's interesting is some of the overseas markets, whether it would be a Spain, a Poland, an Italy, Germany, have actually outperformed the S&P 500 for the last 3 years, and even some of them have outperformed NASDAQ. It's typically under-owned by most in the U.S. They have a very U.S.-centric base, and so we've found good opportunities to go outside the United States, be able to pick up some asset classes that are, I think, at lower risk and better valuations, and the performance has not hurt at all. In fact, this year, obviously, the overseas markets have rallied significantly.
You have been underweight the famous Mag 7, though. Are you still wary of those stocks?
Yeah, we're underweight as we have been since January. Part of it was the fact that their own success in 23 and 24, such good returns. We rebalanced and we just took it down based on the fact it became more and more of a center of focus of every investor you talk to had way too much overweight, including the indices. So we looked to broaden our diversification out in our portfolios. It served us well this year as the Mag 7 has really underperformed. It's rallied in the last month, but overall still not a place that. Again, we still like it, but we just like it a lot less at these valuations. And there's other places to put your money.
Right. Yeah, I mean, you kind of heard it was the only game in town. I'm just looking at the NASDAQ today. We have seen something of a rally. Alphabet jumping at one point more than 5% today. So it looks like some money going back into the tech stocks. But as you say, for a long time, it looked like it was the only game. And I guess indexing accentuated that. What are your thoughts? I mean, as an active manager, you're probably not going to be a huge fan of indexing, but does indexing create a risk of a self-reinforcing bubble in the biggest stocks?
It does, to the extent that you start to have all the monies going to chase, obviously, market cap indices, kind of a success begets more and more success. And then when they do have a hiccup like they did this year, you'd see lots of funds that are indexed down a lot more than an active manager in a market like this. In the last couple of years, obviously, with 7-8 stocks driving most of the returns, it was great to be indexed because you had a lot of exposure there. But yeah, it's a concern. There are places that we like to index, areas that I can't necessarily directly invest. Some of the European countries I alluded to. I'm not going to buy a lot of stocks in Poland, but the ETF gives me great exposure to stocks I normally couldn't get.
Apparently, some people thought Google's AI presentation was stunning. And I see Nicole Newhen in the Wall Street Journal tried out the instant translation service. And apparently, it's pretty amazing. So I'm looking forward to trying that. Yeah, you have some stock ideas for us. NextEra Energy, NEE, the big power seller. What's the attraction there, do you think?
In this environment, we like utilities. I think utilities, again, under-owned. The thing about utilities in particular, this one, is they got a little bit of an exposure to some of the wind and a lot of the solar. But one of the things that's interesting about utilities is people are moving to Florida, and that's a Florida-based company. So the demographics are such that Florida's been a top 2 net gainer of and individuals moving here. And the other thing I like is the stock isn't extended. Sometimes what happens is we find some stocks and I'll come on and talk about them, and they're at 52-week or all-time highs. This is taking a little bit of a breather. I think it's a great story. People are moving to Florida, new constructions, new houses. Even though that's slowed a bit, up north it still gets cold, and it will again, and more people will move to Florida.
That's interesting. Emera, one of our Canadian utilities, has Tampa Electric with 800,000 customers. You just reminded me there. Another idea you have for us is Chubb, the insurer.
Yeah, it gives us an exposure again to out of the country. It's Swiss domiciled. Berkshire is also a big holder of it. But we think insurance, obviously not health insurance per se, because what you've seen happen with some of the big, large U.S. health insurers have been some problems. But this is a big company with big, well-pocketed clients all over the world. And the business is a fairly predictable business. As I mentioned, Berkshire was a huge buyer in 23 and 24. It hasn't rallied that much yet. I still think it's attractive, and we think insurance is attractive in this area, specifically property and casualty, non-healthcare.
Michael, thank you very much indeed for joining us.
Well, my pleasure.